Before we start the video, I'd just like to introduce our new revision package. For $10, you get 7 days access to our entire ACCA Performance Management exam course. For more details, please check out the links in the description below. And now, on to our video. Hello everyone, and how are you all doing today? So today we're going to be attempting yet another ACCA Performance Management past paper question. This time we're going to be doing one from the June 2018 past paper, Section C, question number 31. And the topic of this question is transfer pricing, which of course is a very popular topic when it comes to Section C of the exam. Okay, so without further ado, let's get into the question. Now, the question this time will start with requirements as always. Part A. Under the current transfer pricing system, prepare a profit statement showing the profit for each of the divisions for the Portable Garage Co., which is the company in the case, as a whole. Your sales and cost figures should be split into external sales and interdivisional transfers where appropriate, and this is for 9 marks. Right, so preparing profit statements for the divisions and the company as a whole in a transfer price scenario is a question which has become more and more popular in recent sittings. So the best way to approach this is we prepare the profit statement of all 3 of them, the 2 divisions, the selling and the buying division, and the company next to each other. Okay, so let's start by labeling our question. This is question number 31. Once again, as always, we'll make the question title and everything bold to distinguish it from the rest of the answer, and we'll keep it in a separate column to make it look more presentable. So we'll have 3 divisions and we'll have the company as a whole. So what are the names of the divisions in this case? We have Division A, Division B, and we have the company, which is the Portable Garage Co., which is we'll use the shorthand PGC. So we have Division A, we have Division B, and we have PGC, which is the company as a whole. Since these are the titles, always good practice to make the titles distinguishable from the normal text. Okay, now when it comes to a profit statement, remember what we covered in the videos. For Division A, which I would believe is the selling division, in any case, for the selling division, there'll always be a row for the internal sales, right? They'll be making external sales to their outside customers and internal sales to the buying division. Meanwhile, the buying division will have 2 types of costs. They'll have their external costs for their regular expenses, and they'll have their internal expenses from buying from the selling division, right? And the company as a whole will simply be, their profit and loss statement will simply be the sum of the profit and loss statements of the 2 divisions, excluding all internal transactions, which are the internal sales of the selling division and the internal expenses of the buying division. Now, since those 2 amounts will be equivalent to each other, they'll cancel out anyway, the net result will still be the same. The company's overall profit will still be the profit of the 2 divisions added together. Okay, so let's go through the question and see how we manage. So it says the Portable Garage Co. is a company specializing in the manufacture of and sale of a range of products for motorists. It is split into 2 divisions, the Battery Division B and the Adapter Division A. Division B sells 1 product, portable battery chargers for motorists, which can be attached to the car's own battery and used. Okay, this is all fluff anyway. Division A sells adapters which are used by customers to charge mobile devices and laptops by attaching them to the car's internal power source. Okay, most of that's fluff. Let's move on. Recently, Division B has upgraded its battery so it can charge mobile devices and laptops, etc., etc. That's fine. Here we go. Division B currently buys adapters from Division A. So Division A is the selling division and Division B is the buying division, which also sells them externally to other customers, and Division A, the selling division, sells to Division B and external customers. Okay, so Division A will have internal and external sales, and Division B will have internal and external costs. So let's start with Division A. There will be their external sales, and please make this a regular rule of thumb. they mentioned it here already that your sales and cost figures should be split into external sales and interdivisional transfers where appropriate, but that should be regular practice. If you're making a profit statement for the divisions and a transfer pricing question, even if they don't mention that, you need to show external and internal sales, external and internal costs separately. Okay, so we'll have external sales and internal sales. Okay, so let's start with division A's data. So division A, the selling price per adapter to division B is $13. Okay. Oh, and we'll need to know the number of units as well. So let's just read the information below as well in case that has any relevant information to the calculation. In addition to the material and labor costs above, division A incurs a variable cost of $1 per adapter for all adapters it sells externally. So that's important. We need to note that. Currently the head office's purchasing policy, yeah, this is important, okay, only allows division B to purchase adapters from division A, but division A has refused to sell division B any more than the current level of adapters it supplies to it. Okay, so with the transfer pricing question, always a good place to start is the capacity to see how many sales are being made externally and internally. So division A's current capacity for both internal and external sales is 350,000. So that's how many units they can sell in total. Their maximum annual external demand for adapters is 200,000. Okay, so they still have spare capacity of 150,000 that they can sell to B. And B, on the other hand, currently has annual production and sales of portable batteries of 150,000 and a maximum annual demand for the portable batteries of 180,000. So they're currently selling 150,000. Ideally, they would want to sell 180,000. So the 150,000 gives it away that they're restricted by the fact that they can only buy from division B and they can't make any further of their units. And what that also means is that since they can only make up to 150,000 units and A only has a spare capacity of 150,000 units, it means 1 unit of A is needed to make 1 unit of B. Okay, sometimes they'll mention that in the question, sometimes you could figure it out like this as well. Okay, now the manager of division B is unhappy. He has a special industry contact from who he could buy the adapters from at exactly the same price as charged by division A. So this would be relevant to the transfer price calculation, which we'll probably have later on. And after discussions with both of the divisional managers to ensure that the managers are not demotivated, head office has agreed to change the purchasing policy to allow division B to buy external. Okay, that's not relevant to our calculation. So basically external sales for division A would be the 200,000 demand and internal sales would be the remaining 150,000 that they're going to be selling on to division B. So division A's external sales is going to be 200,000 into what's their selling price for external sales? Selling price per adapter to external customers is 15. So into 15, okay? So approximately 3 million. And for internal sales, it's going to be the 150,000 into the internal selling price of $13, okay? And since this is all going to be in accounting format, let's just make it easier for us to read with the commas in between. Okay, now keep in mind that these internal sales of division A will be equivalent to the internal costs that division B incurs for buying from division A. So the adapter from division A is also for $13 and they're also buying 150,000, so it'll be identical in cost to that. Okay, so we might as well just fill that out as well. So cost of internal cost of adapters, and mind you, this is not relevant to division A or the company, this is just relevant to division B. Just like internal sales are just relevant to division A, they are not relevant to division B or the company. Okay, so that's that. Okay, now let's go to our costs. So division A has the following costs: materials, labor, and then they have fixed overheads. And in addition to the materials and labor above, they have a variable cost of $1 per adapter for any adapters it sells externally. Okay, so this is not relevant. We'll move on to the next one, which is materials cost, then labor cost, then cost additional variable cost for external sales, right? Let's be clear on what we're including in all of these so that the market can follow. Okay, so material cost will be minus $3 into how many units in total? The 350,000, 200,000 to division B and 150,000 to division B and 200,000 externally. Likewise, labor cost will be minus 4 into 350,000, right? And the external variable cost, now we need to be careful, right? It'll be minus 1 into just the adapters that are sold externally, so the 200,000 adapters sold externally, not 350,000. It's easy to make these mistakes when we have momentum, so please be careful. Okay, so minus 200,000. okay, and this will give us our total contribution. So we'll simply sum up all of these values. So 2.3 million, okay, and we'll make this bold since this is a major profit, right? Okay, then we have our fixed overheads, which are minus 2.2 million, okay, so that gives us our profit, which will be 100,000 for division A. Okay, so with that said, let's move on to division B. For division B, the cost, this internal sales is no longer relevant like we said, but the external sales will be relevant. Now their external selling price is $180 as mentioned up here, and they're going to be selling 150,000 units. Okay, so 180 into 150,000, right? They won't have any internal sales. Let's move on. Then their materials cost, so we've already included the $13 of buying from division A. The material cost from external suppliers will be $45. Okay, let's just be more explicit then, since they mentioned external suppliers. Let's call them external material cost. External materials cost, right? And this is going to be minus 45 into, again, there's 150,000 units being produced. Okay, and then the labor cost minus 35 into 150,000. Any other cost? Just as a fixed cost of 5.46 million. So we'll just take the formulas here as needed. This will become minus 5460123, and this formula will be taken as is. So the profit for division B is 7.59 million, whereas the profit for division A is only 100,000. So this might indicate, not part of the question, but just for general analysis, that division A is not getting a good enough price, right? Because they're selling for a cheaper price than they do normally, and division B is getting a very good price, so that their profits are high. But division B doesn't seem to be happy because they're restricted in supply, so their profits could potentially even be higher in that sense. Okay, finally the company profit and loss statement, very simple. What did we say? We simply add up the profit, the statement for division A and division B, excluding the internal parts, right? So we'll exclude the internal parts but add up everything else. Okay, and as we can see, the profits still add up to the sum of these two. Why? Simply because this 1.595 million cancelled out with this negative 1.95 million. So there we have it, the profit and loss statement for the two divisions and the company as a whole. Please do make them side by side like we did here in one go, right? What the examiner has complained is that sometimes students make them separately. So there will be one for division A, then down below the next one for division B, etc. And they'll say it's more time consuming. Okay, so make them collectively. Okay, so let's move on to part B. Okay, so what does part B say? I'm assuming it's going to be now transfer pricing. Okay, so it says assuming the new group purchasing policy will ensure the optimization of group profits. Let's stop here. Immediately from our videos, we know If they're emphasizing group profits, optimizing those, maximizing those, we're gonna have to do the analysis from the group perspective, the company perspective, which we've covered in our videos, okay? And it says calculate and discuss the number of adapters which B should buy from A and how many A should sell to external customers. Yeah, so the typical company based analysis on how much should the selling division sell to the buying division and how much should they sell externally to maximize the company's profits. Because remember, the company is not concerned with the level of transfer price, they're just concerned with the internal and external sales. And it says there are 3 marks for calculations, 3 marks for discussion. So we can't just do a calculation and be done with it. We need to explain what's going on. Okay, so as always, we start with our capacity. We've already analyzed the capacity for our calculation. Right now, the situation is that A is supplying 200,000 units internally and 150,000 units to B and remaining within the capacity. But what has happened? They're saying assuming the new group purchasing policy. And what's the new group purchasing policy? Like we saw in the last paragraph, it says after discussions, the head office has now agreed to change the purchasing policy to allow Division B to buy externally. So Division B will no longer be restricted to the 150,000 sales. They can potentially have 180,000 sales. But the question is, these extra 30,000 units, should they buy from outside or should they ask Division A to forego some of their own sales because they're already at full capacity and sell them to Division B? So that's the analysis we're doing here, okay? So option one is, let's just write this down. There are 2 options here, or let's just start with this now. Currently, Division A is fulfilling its entire capacity of 350,000 units by supplying 200,000 units externally and 150,000 units internally to Division B. However, under the new policy, Division B would now want to produce and sell 180,000 units to fulfill its entire external demand. The issue is that the extra 30,000, what are we dealing with? Adapters, right? Adapters can either be bought from Division A or from external suppliers. The company must consider which option maximizes its profits. Now, first off, let's just analyze the existing 150,000. Do they have to change that, or should they start buying 150,000 from external suppliers as well? No, because as long as A has spare capacity, so it has spare capacity of 150,000 because the external demand is only 200,000, that the company will always say that Division B should buy internally. Why? Because if Division B buys internally from Division A, the money remains within the company. It goes from one division to the other. It doesn't go outside the company. So the company, that's good for the company. The issue only comes when A does not have spare capacity and they have to give up something. They have to give up some contribution to sell to Division B. That's when the company needs to do a cost-benefit analysis. So the existing 150,000 adapters will still be purchased by from Division A, because as long as there is spare capacity, internal sales are the best from a company perspective, okay, standpoint, right? Now let's weigh up the 30,000 units, right? As for the 30,000 units, either Division B buys from division A. In this case, division A, so this is the one where we'll have to weigh the cost and benefit, right? So let's keep that for below. Let's do the simpler one first. As for the 30,000 units, either division B buys them from an external supplier, in which case it will cost them the same $13 it did when buying from division A, right? So either they can buy from the external suppliers, in which case A can do whatever they want, they don't have any issues, right? Because B is getting those from outside. Thus in this case, the company is incurring a cost of $13, okay? Compare this to the other scenario. On the other option is, that division B buys from division A. In this case, division A will have to give up the external sale of 30,000 units. This opportunity cost will result in, and remember, opportunity cost is always based on contribution lost of, and how much did they make for external sales? They sold for $15 minus the variable costs, which include $3 for materials, $4 for labor, and the $1 extra cost. Okay, so how much does this make? We'll just put this in brackets. It's 15 minus $8, so $7, right? Okay, so this will result in an opportunity loss of $7. Okay, but furthermore, there's another thing that's going on here. Okay, what's that? So the division A lost the opportunity cost. They lost the contribution, but in order to supply division B with the adapters, they also need to buy them in the first place, right? Prepare them in the first place. So they'll also incur the variable cost. Okay, so the variable cost is going to be, once again, what's incurred for every internal sale, which is materials cost of $3 and labor cost of $4. So in addition to this, division A will still incur the variable cost of supplying adapters to division B, which is $7, $3 material. So we're showing the working here in case of making a typo, so that the examiner knows exactly where we're getting these numbers from. Okay, and this is for the calculations they're asking for. Overall, the company will incur a cost of $14, $7 variable cost, and $7 contribution loss due to contribution loss. Let's just keep it at that, right? Okay, so in our two scenarios, either the company is going to incur a cost of $13 from B buying externally, or they're going to incur a cost of $14, $7 for A to get the adapter for B, and $7 they lose on not having sold the adapter to any external supplier, external customer, right? Okay, so $14 versus $13, we always go for the better option. What's the better option? The company will say that the better option is B, to buy them from an external supplier, right? So they'll say, based on this, the company would want the cheaper option of division B buying from the external supplier so that A can fulfill its external demand entirely. Okay, so there we go. There's an analysis. 3 marks for discussion and 3 marks for calculations, which were all included in text form. We left spacing in between so that it's easier to read and follow. Okay, so again, usually I make the diagrams to show this, so I didn't do that over here, but I hope you were able to follow. Okay, so part C. Now, part C, what's the situation? They're saying, assume now that no external supplier exists for the adapters which division B uses. Okay, so now there's no external supplier, so they can't go for what we just said. Calculate and discuss what the minimum transfer price per unit would be for any additional adapter supplied above the current level by division A to division B, so that division B can meet its maximum annual demand for the new portable batteries. Okay, there are 2 marks available for calculations and 3 marks available for discussion. So now we just need to calculate the minimum transfer price, and we need to discuss. Technically, what we've already calculated the minimum transfer price up here, because we've already added the variable cost and the contribution lost, but we can do that again. Okay, so we'll start by mentioning the minimum transfer price formula. Minimum transfer price is equal to the variable cost, which is based on the internal sales, plus the opportunity cost, which is the contribution lost on external sales, right? Okay, and we've already technically calculated that. Now we're saying that division B cannot buy from external suppliers. What does that mean? That A will have to supply the 30,000 units, so they'll incur a variable cost for supplying them to B, and for those particular 30,000 units they'll incur an opportunity cost because they'll have to give up those external sales. Okay, if there is no external supplier, then division A will have to supply adapters to division B. This means that division A will have to give up sales of 30,000 units. Okay, for the original 150,000 units, the minimum transfer price will simply be the internal variable cost of $7, which was a $3 materials plus $4 labor. Okay, however, for the additional 30,000 units, we must also incorporate the contribution lost from the external sales that division A had to forego. Okay, this will be equal to, we've already calculated above technically, $7, which is the $15 they sell the product for externally, right? $15 they sell it for externally, less the $3, $4 variable cost, and the $1 cost for an adapter for external sales. So 15 minus 3 minus 4 minus 1, right? This makes the total, the minimum marginal transfer price for these 30,000 units $14, right? 7 plus $7 plus $7. Okay, so we've done the calculation and we've given the discussion on what's going on, what's the scenario. Okay, so we're done with the question here, and hopefully it's clarified a few matters for you and it's been beneficial for you. As always, transfer pricing questions, they always have their little twists and turns depending on which year they're from. So I always advise try to do all the released past paper transfer pricing questions from ACCA so that you're familiar with all the twists. So in this one, the twist was, one, you had to prepare the profit statement. For that, what did we say? Simply prepare the profit statement all next to each other for each division. For the selling division, there will be internal sales. For the buying division, there will be internal costs, which should cancel out with each other. Separate the internal and external sales and costs in the profit statement, and the company's profit statement will simply be the sum of all the numbers of the two divisions except for the internal sales and internal costs. Okay, after that we have the analysis for the company. Whenever they mention optimizing group profits, we need to do the analysis for the company, the one with the diagrams which we covered in the videos. We did that over here, and you can review those videos if you still need more practice, and then come back and revisit this question on it. And then we calculated the transfer price based on the last scenario requirements. Okay, so with that said, I'll see you guys next time.